So there are 5 mysterious numbers hiding on your options trading screen right now. And they are either making you rich or slowly draining your account. And knowing what these are and how they affect your trading is what separates beginner traders from professional traders. So most traders see these Greek letters like delta, gamma, theta, vega, and completely ignore them, and then wonder why their winning trades keep losing money. They buy a call, the stock goes up exactly like they predicted it, but somehow their option isn't moving. It's worth less than what they paid for it. So does that sound familiar? So here's what I have discovered after years of trading and helping hundreds of students achieve profitability. These aren't just random numbers cluttering your screen, or your brokerage isn't just throwing these numbers at you. They're actually the secret language that reveals exactly how your options will behave before you even place the trade. These Greeks will tell you if your option is going to make you money or you're going to lose money from the time decay or get crushed by the volatility. So all before you risk a single dollar. If you don't know who I am, my name is Sonia Gill. I'm from Gift of Trading. I've been trading for the last 5 years. And in this video, I'm going to explain all options, Greeks for you. So by the end of the video, you'll read options like a pro trader. All right, let's start with the basics. When you trade options, you're not just buying or selling random contracts. Each option has numbers attached to it, and it's called the Greeks. Now, these Greeks are a simple way of measuring how sensitive your option is to different things like stock price movement, time, or volatility. And I'll be honest, when I first saw Greeks on my trading platform, I thought I was back in the math classroom. And I'm not the one who is good at math or numbers in general, okay? But once I learned what each one meant, everything changed. Options went from feeling like gambling to feeling like a strategy. So stick around. I'm going to break each one of them down, exactly what they do. And if you stay until the end of it, I will actually show you an example and give you a cheat sheet that you can use to calculate all of these as well. So let's talk about the first one, delta. So delta tells us how much an option's price going to move when the stock moves by $1. So for example, option has a delta of 0.50. That means if the stock goes up by $1, your option will gain in value about 0.50. If stock drops by $1, your option will lose about 0.50. So think of delta like the gas pedal in the car. The higher the delta, the faster your option reacts to the stock price. So when I first started trading, I used delta to figure out how much exposure I really had. A call option with a delta of 0.70, that's like controlling 70 shares of stock, right? That blew my mind because I realized I could scale my position without actually owning all those shares. So that's delta. Now let's go to gamma. Gamma is a little trickier, but here's the simple way to think about gamma. Gamma measures how much your delta changes when the stock moves. So if delta is the gas pedal, gamma is how sensitive that pedal is when you press it. So for example, if delta is 0.50 and gamma is 0.05, so when the stock moves $1, your delta changes from 0.50 to 0.55. That means your option gets more sensitive the more the stock moves in your direction. So I remember one trade where I ignored gamma and stock ripped higher, and suddenly my delta exploded and my options got way more aggressive than I expected it. So that's when I learned gamma can make or break fast moving trades. So now next is theta. It's the time decay. That's my favorite Greek because it's sneaky, right? Theta tells you how much your option's going to lose every single day just by time passing, okay? As the closer the expirations are, your theta kicks in very quickly. So options are wasting acids every day, especially close to the expiration. They melt in value. So for example, if theta is minus 0.10, your option loses 10 cents in value every day. Even if the stock doesn't move the way I explain it, theta is like an ice cream. The longer you wait, the more it melts. And if you ever held a call option over the weekend, you know exactly what I mean. So theta is very, very important when it comes to selecting the right options contracts. Okay, so make sure that you are paying attention to your theta, your time decay, you're selecting the right options contract with the right expiration date. Now, next is Vega. That's volatility. Okay, so Vega measures how much your option price changes when volatility changes by 1%. Higher volatility equals higher options prices, and lower volatility equals cheaper options contracts. Okay, so if you buy an option when volatility is high, you're paying for a high premiums on it. And if volatility falls, your options can lose value, even the stock goes in your direction. So that's why I always check for earnings. Options get expensive because Vega shoots up, right? Now the last one, it is called REO, which is for interest rates. And REO, I can't even pronounce the thing. It's RHO. It measures how sensitive your options is to interest rates. So to be honest, most day-to-day traders don't worry about the REO too much because rate changes aren't happening every minute. But if you are holding long-term options, REO can have an effect. So keep it in the back of your mind. It matters more in slower moving and long dated contracts. Okay, especially now we have the Fed's interest rate decision is coming up. So if you are holding your long dated or your LEAPS options contract, this is where it does affect as well. So when you open up your brokerage, this is a screenshot out of Viva. So all of the information is provided by your brokerage. You do not have to go do any of this manually, okay? Just so I don't want anybody to be like, oh, now I got to pull up a calculator and do math and figure these numbers out. Everything is given by your brokerage. So you'll see those columns. Some columns might be hidden, so you just have to go into your settings and get them on. So as you can see, it says Vega, implied volatility, theta, gamma, delta, open interest, which I'll cover it in a different video, and then bid and ask and your strike prices. So what we went through was the delta, the gamma, theta, implied volatility, and our Vega as well. So now I'm going to give you an example of using all these numbers. Let's say you bought a contract and now your stock is up $2 or gone down $2. So we're going to look at two options, where you would be able to calculate how much money you would make the next day or when the stock goes up, or how much would you be losing it if stock did that. So what we are going to do is we are going to take this strategy and use as an example. So it's a swing trade, basically based on a price going up $2 or price going down $2. So let's say you paid, the ask price was $1.20 and you paid for that contract $1.20, and your delta is sitting at 0.42 and your gamma is sitting at 0.11, and your theta is at minus 18. So we're going to take all these numbers and see how this works out. So what is the delta impact? So initial delta impact for every dollar increase, you are making 0.42 times 1. So which means your contracts are up now 0.42, right? So now for every other dollar that goes up, we are now gonna get the adjusted gamma in there as well too. So what is our gamma? Our gamma is 0.11. So what we do is 0.42 plus 0.11. So now your contracts are up 0.53. So you paid $20. You got for the first dollar, you got your delta for 0.42, and now for the second dollar increase, because the stock is going up, you got that extra gamma in there, which was 0.11, right? So now delta impact for the second $1 increase is 0.53, so you're up basically $53 per contract if you have multiple contracts. So total in total, because your first dollar gave you $42, and then your second dollar that when the stock went up $2, now you got your first $42 plus the $53, which equals 0.95. So the contracts that you paid for $20 now are adding into it 0.95. However, we got to include the theta impact. Remember, the theta has minus at the front of it. So we are going to minus that 0.18. So total change is 0.95 minus that theta 0.18. Actually, for at those $2 move up, you're making 0.77, which is $77. So 120, which you actually paid for it, and now stock went up $2, you made 0.77. So your contracts are worth at $1.97 tomorrow. So that's how when the stock goes up $2 in your direction, that's how you make money. So now let's assume you took the swing and the stock didn't go in your favor and you lost, stock went down $2. How would it impact? Exact same rules, but this time we are minusing it. So for the $1 decrease, our contracts went down by 42 cents. The second dollar increase they're considering, which is minus 0.11. So that means minus 31 cents. So your total delta impact for the second dollar is 0.31 times 1 equals, 0.31 is what is going to be impacting for that second dollar. So now we're going to add for the first dollar down, and then we're going to add for the second dollar going down, which is 42 cents plus 31. That means you are now losing about 73 cents for that $2 going down. However, we haven't added the theta impact, right? We added the theta here, we minus the theta here as well. You got to do the same thing. So not just because of your delta and gamma you lost money, but the theta impact is another 18 cents. So now in total, you're losing about 91 cents on those contracts. So if you paid $20, now you're gonna minus 0.91. That means your contracts are only worth 29 cents. So take this example, look for some examples from your brokerage and use this calculation and see if it can help you to pick the right options and contracts with the theta, why it is important not to, trade with the shorter dated expiration swings, because that's how theta, delta, gamma, everything can impact and you can lose money quickly. All right. So I hope you guys enjoyed that little cheat sheet, but let's wrap this up. And what are the 5 Greeks? Quickly re-review it. Delta equals how much your options move when the stock moves. Gamma equals how fast delta itself changes. Theta equals how much value you lose every day from time decay. And Vega equals how volatility affects your options price. And then Rho equals how interest rates play a role. Okay, so here's the truth. Without the Greeks, options look like gambling. With the Greeks, options become a system. So this is what separates the successful trader from everyone else. So the next time you open your trading platform, don't ignore those little numbers. They are your roadmap to trading like a pro. And that's exactly how the options Greeks work. They're not just random numbers on your screen, they're your roadmap to the profitable options trading. So when you understand delta, gamma, theta, you're no longer guessing. You're making informed decisions based on the real market mechanics. Okay, this is the kind of knowledge I teach every day in the gift community, where we are building a family of empowered traders who understand the market at this deep level. If you want to take your trading to the next level and join hundreds of other traders on their journey to financial independency, check out the link in the description. But regardless of whether you join us or not, you now have the tools to read any options contract like a professional trader and use this knowledge, respect the process, and remember, successful trading isn't about luck. It's about understanding exactly what you are looking at. And if this video helped you finally understand the Greeks, hit that like button and share it with another trader who needs to see this. And thanks for watching. I'll see you guys in the next video.